Hello financial fans, welcome back to another stock analysis. Today we'll be covering Altria Group stock ticker MO. Altria Group Incorporated is an American corporation that is one of the largest producers and marketers of tobacco, cigarettes, and related products. The company is the parent company of several well-known tobacco brands including Marlboro, Black & Mild, and Copenhagen, among others. Altria Group also has a growing portfolio of wine and spirit brands, as well as a minority investment in the Canadian cannabis company Cronos Group Incorporated. In addition to its core tobacco business, Altria Group is committed to supporting public health initiatives and reducing harm associated with tobacco use. The company works closely with regulators and public health organizations to promote responsible use of its products and reduce smoking rates, particularly among youth. They currently are sitting at an $83.3 billion market cap, and in 2022 they generated a revenue of $20.7 billion. They're sitting at a very high dividend yield of 8.01%. 86% of their revenue comes from smokable products, 12% from oral tobacco, and 2% from the wine products. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25%, which can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from almost $8.4 billion in 2013 to just over $12 billion in 2022. The average growth in EBIT during this period was 4.3%, which makes it not qualify for a margin of safety deduction quite yet. The margin has also gone up, going from 47.3% in 2013 to 48.2% in 2022. The average margin growth was 0.5%, which once again means no change in a margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up, going from $1.52 a share annually in 2011 to $3.76 a share annually in 2022. The average dividend growth during this period was 8.7% annually, which means a 5% margin of safety decrease. The payout ratio is sitting at a very high 115%, meaning a 5% increase in a margin of safety. The final two metrics that we'll be looking at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. And for Altria, this is almost 2 years, in this case a 191% debt to EBITDA ratio, which means no change in the margin of safety. The return on invested capital, however, is setting a very nice 13.2%, meaning a 5% deduction from a margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Altria Group. The first model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in free cash flow annually during this period was 12.5%, and I'm projecting a growth rate of 4% annually over the next 10 years. With this percentage, we can determine the future free cash flow of Altria Group and determine a terminal year valuation using a perpetual growth rate of 2% and a discount rate of 9%. This leaves us with a sum of free cash flow of $131.2 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $107.7 billion. And to get a discounted cash flow price per share, we just have to divide it by the amount of shares outstanding, leaving us with a price per share of $60.17, which is an upside of $13.38, which is almost a 30% upside. The second model we use is the dividend discount model, and I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate in dividends during this period was 8.75%, and I'm projecting an expected growth rate in the dividends over the next years of 4%, and we'll once again be using a discount rate of 9% in this valuation model. And this leaves us with a price per share of $78.21, which is a $31.42 upside. And in percentages, this is 67.15% upside. The third model we'll be looking at is the Graham's revised valuation formula. In this valuation model, will be looking at the earnings per share that Altria is generating, the growth rate estimate of Wall Street over the next 5 years, and the current yield of AAA corporate bonds. And we'll be going off the PE of a company with no growth of 7. And this leaves us with a fair value of $40.80, which is a $6 downside and almost in percentages a 13% downside out of this model. The fourth model we use is the multiple valuation. In this model, we'll be looking at similar companies to Altria, look at their stock price and earnings per share to determine an average PE multiple in the industry, which in this case is 15.53. To get our fair value, we'll have to multiply by the earnings per share that Altria Group is generating, which is $2.28 a share, leaving us with a fair value of $35.42, which is a downside of $11.37. And in percentages, almost a 24% downside, or just over a 20% downside out of this model. The last model that we use is the mean reversion theory. In this valuation model, we go by the theory that a company will always trade above or below its mean. And the factors that we use to take this into account is the dividend yield and PE ratio. In this case, I've imported the dividend yield from the last 5 years, which left us with an average yield of 6.45%. And the current yield is 8.01%, which means it's undervalued looking at the dividend yield. We'll also be looking at the PE ratio, and the average PE multiple over the past 5 years was 19.54. And the current PE is 14.67, meaning also out of this metric, it's also undervalued. The upside out of this model then is $13.44, which is almost a 29% upside out of this model. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, multiple valuation, and the mean reversion valuation prices per share, leaving us with an average of $54.96. Without a margin of safety, this would leave us with an upside of almost 17.5%, but we have calculated our margin of safety earlier using standard margin of safety of 25%, deducting it by 5% for return on invested capital, by another 5% for the dividend growth, and adding 5% for the payout ratio, leaving us with a 20% margin of safety. Applying this margin of safety, we get a fair value of almost $44, which, with the current price of $46.79, is a downside of 6%. So in this case, it would be considered a sell, but I would more so say it's a hold, since it's a company that you will hold for dividend income. But I wouldn't personally enter at these prices. If there's any other companies that you would like to see on this channel, please let me know in the comments. And thanks for watching.